Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. So in this course, we'll be looking at the topic of technical market structures. Just before we go in and explain the outline of what you can expect over the course of this course, please do take a brief moment to familiarize yourself with our disclaimer and do always be aware of the risks involved in trading these financial markets. Okay, so let's go through the outline of this course. So we'll start with an introduction to technical market structures. We'll just explain fundamentally what they are and how and why technical traders use them. Then we'll have a look at price charting and look at some of the things that you would need to look for if you were looking to identify structural highs and structural lows. Then we'll identify market structures and practice. So I want to take you to some live charts where you'll be able to hopefully identify and be able to identify them in your own trading as well, which is always very, very important. And we'll also look at structural failures. So structures that can obviously support price in a particular direction, but we can also see and experience, and we do on a regular basis, we can experience structural failures, and they can present some very unique opportunities when trading these markets. Then we'll have a look at why market structures present opportunities, and we'll finish with the importance of patience, because it does play a very, very important role when we're looking at trading certainly market structures. Okay, so let's start with an introduction to technical market structures. So a technical market structure is when a market achieves a swing high or structural high, which is also called as a structural high, followed by a swing or structural low, and vice versa. So it's important the opposite also applies. Now, it's the relationship between these highs and lows which gives a trader a great insight into being able to read what is effectively going on in these markets. So that's why they're useful, and something that should be an advocate. Every technical trader is very much an advocate of knowing and understanding these technical market structures. So really, when we break down technical market structures, we're talking about focusing the focus of swing highs and swing lows, and of course the other way around. So what we mean by that, also looking for the relationship and the focus between swing lows and swing highs. So can technical market structures can absolutely be identified in any particular time frames. And when we have a practical look at these market structures and we're looking at different charts, I'm also going to take you through the process in different time frames. And as you can see, it is practically the same. So we can identify technical market structures in any time frame. The larger the time frame, also the more important the structure, the market structure becomes. So if we're talking about a structure in a daily chart, it has far more significance than a structure in a 1-minute chart, for example. Technical market structures can support a price pattern, but these structures can also fail. So part of this webinar, we'll have a look at these structural failures. We'll show you how to identify them, and then we can look at some of the opportunities that can present themselves when we see these structural failures. Now, a general understanding of technical market structures can provide traders with the knowledge and understanding necessary to read a technical price chart. So that's ultimately what we're talking about here, is the ability to understand what's going on when we look at a trading screen. And finally, these structures can provide traders with some fantastic tradable opportunities, and that's the important point to make. So let's look at the principle of technical market structure from a price charting perspective. And of course, technical traders can use a whole variety of indicators, for example, Fibonacci retracements, or they can look to identify price consolidation and channels and other price patterns also can be provided. Now, technical market structures focus on observing the most recent price action in an attempt to understand what is happening to price action from a technical perspective. So what we mean by this is all technical traders should have a basic understanding of technical market structures. And it's really understanding the more recent price action and how that interacts with perhaps previous and slightly later and historical price action. It all converges and it all starts to build a picture so that those that are trading these charts can understand what's going on and have a basic understanding. Visually, a trader is to visually observe and understand the interaction between buyers and sellers at these structural highs and lows. And the important part is to notify that this is very much a visual observation. Yes, there is indicators that can assist you in this fashion, but for a trader to have a basic understanding, they very much need to be able to identify it on a price chart. So we are talking about visual observation, and it is that interaction between the buyers and sellers and understanding that dynamic when it comes to these structures. So does a structure hold or does it actually fail? And depending on that answer will determine the opportunity that may exist. It's important to analyze the recent price action in relation to potentially identifying a trend as well. So these structures can fit very nicely within a trend, so it can be very supportive of that trend. So we always speak, when we talk about trends, we talk about higher highs and higher lows in an uptrend and lower highs and lower lows in a downtrend. And these price structures support these trend formations and pricing patterns. And the last thing is to attempt to enter the markets at the best possible time. So that becomes the challenge, let's say, for the trader. So once they understand and they can read these markets, they give themselves a fantastic opportunity to capitalize on those opportunities. And what is then left is timing and the ability to enter these markets at the right time based on some of the information that they're able to acknowledge and understand. Okay, so let's have a look at being able to identify structural highs and structural lows. So they do help us understand what is going on with each individual market. So that's important to note. So let's take a practical look at being able to identify these structural highs and structural lows. Now for this, I'm going to get up our trading platform. And we're just going to observe and see what is currently happening with this chart. And we're going to look at different markets over different time frames. And the same principle applies, trying to identify these structural highs and structural lows. Now, straight away, when we look at this is a euro-dollar chart, and it's a 1 minute time frame. So what we can do is we can use very, very basic tools to help us identify swing highs to swing lows. And even within that, there is potential opportunities, even over a few minute period, just because this happens to be a 1 minute time frame. So the process of identifying these swing highs and swing lows is relatively easy. We're taking these lows and we're monitoring this high. We're also seeing and identifying the breakout of what is effectively the 1914 level, and this is how these markets move. They continually move, but it gives us some fantastic information. So when you mix this type of identifying these structural highs and structural lows, you can identify some fantastic opportunities. And to just take you through a couple, and I'll just get up my pen very briefly. There's a very interesting price pattern forming here where we're getting a price move to the downside. You can see it's being supported at this level, the 1935. We get a little bit of a reversal, creating a structural high, and we get another attempt to make a new low. But as you can see, this level does stand up. Yes, we do break beneath that level, but it reverses back above it. So from here, we can trade this potential opportunity. We could even buy the double bottom, which is a viable trade. It's what some traders look for. So buying that double bottom, And there's another very important price pattern forming, which is buying a double bottom at the actual level of support, but also as a break of the structural high. So there's actually a structural failure, what's called a structural failure to the upside at this. So what that can present is a couple of opportunities. So buying the low of what is effectively the double bottom is opportunity number one, and the structural failure, which is the market was clearly moving in one direction, which is to the downside, and now we get a reversal signal. So this, for technical traders, can be a very good and viable opportunity number two. So they're not just trying to capture one opportunity and that's it. You get multiple opportunities over multiple timeframes. So that's just a couple of examples there regarding the euro dollar. So the same thing applies if we looked at a 15-minute time frame now, and we can see what's going on in this market. And let's try and read what is effectively happening. So what we can do is we can identify those highs, and we can identify major swing lows, and we can see what's going on in between these levels, and see how this chart begins to formulate. When all we're doing is we're just identifying these highs and lows, and it starts to, you can see price action beginning to converge around these levels. It can be argued as well that there is a kind of a double level around that kind of price point, and straight away we can see that ultimately we're in a pretty, I mean, this isn't great price action either from the upside or to the downside. We're making new highs and we're making new lows. But ultimately, what we're experiencing is a sideways moving market with a slight downward tinge in this market. So ever so marginal, it would be favoring the dollar in a very, very small way. And that's just looking at this 15-minute chart over the time period along the x-axis. Now we can look at the most recent price action. We can see there's clearly defined bottom just around this level between the 35.33 and the 35.39. Now if we get a break of the lower band, which is the 35.33, then the likeliest outcome is that you're going to get an explosive move. So we can use these levels and understanding these structural highs and structural lows to identify not just where to place a stop loss. So if we got in at this point in and around here, we could use the structural high to for our risk management purposes in terms of a structural a stop loss being placed above a structural high, and we could also use the previous structural lows as an opportunity to book in profit. So that's how traders can use and identify a lot of this information to make some considerable decisions when it comes to trading. And we'll discuss the importance of patience as well, because there's no point preempting that move prior to it happening. So it is a case of being prepared for that move. And there's obviously some tools that can be used as well to capitalize on a break. You could use a pending order, a sell stop order below the 35.33, for example, if you weren't able to sit and wait for this opportunity. And then of course there's opportunities to trade again, like potentially a double bottom to the upside, and a break above the structural high could constitute an opportunity to drive this price even higher. So this is the basic process that certainly a technical trader that looks to identify these structural highs and structural lows, and that's how they look to go about capitalizing on some opportunities. So this now is the FTSE 100. So it's a 1 hour time frame, and we'll just capitalize on some structural highs again and structural lows. So we can identify these levels, and you can see that they can begin to replicate themselves on a number of occasions, and that's the important aspect of technical analysis. So there's nothing particularly sophisticated about this process. just apart from the fact that you're just acknowledging and identifying these highs and lows. So starting from the bottom left, we can see that price is starting in the bottom left, and we're now top right. So that's a pretty sizable move. But as you can see, this market over the particular time period has gone through significant consolidation before we capitalize on the breakout, and then we make this structural high. So there's breakout traders that will be looking for periods of consolidation. It could be argued that there's a slightly earlier opportunity to take this market to the upside, but if not, just looking at these recent highs, there's an opportunity to get in there. Again, it's quite straightforward from a stop loss perspective. You're placing your stop loss below a level of what is initially resistance, then converts to support, and we're seeing that explosive move as a result of that, with some considerable volatility coming in to this market. But then you see the market look to bounce off a level of resistance, which prevents markets from moving higher. And look where it comes back to. It comes back to a previous level of resistance, which could have provided us an opportunity the first time round. So when traders see this kind of price action, they can again clearly define their stop loss from a risk management perspective, and they look to capitalize on this trade. So they can put all of this information together to provide themselves with some really interesting opportunities. Now, it's nice to see that this market pulled back from these recent highs, again, back to a considerable level. I mean, if we wanted to be ultra accurate, we could probably bring it down exactly to these lows, which I shall do now. So if we just, you can see it matches up with the highs of this market, matches up with the lows of those, and the traders that understand how to trade these structures can capitalize on a whole variety of different trades for a whole variety of different reasons. So that's the FTSE market, and just the final market to show you, which is the dollar index market, which is very much a daily time frame. This is currently up on screen, and let's just identify these highs and lows, and you can see how the market interacts and behaves with these levels. And all of a sudden, it starts to formulate a bit of a picture. Now, this is a fairly recent move in the dollar index, and I want to draw your attention to kind of what has happened at this area, and again, just ever so marginally higher. So there is other levels that could go in there, of course. I might as well put them in now. So you can see how this price action has been behaving around that kind of level. And yeah, let's work with these highs as well. You see, the confusing thing for traders is some of these can be infinitely more important than others. So we're identifying this bit of price action. So we can clearly see that this has been very much a range-bound market for quite some time until we get to this point number one, and this is point number two. And to just identify what's going on in this first box here is that we get a confirmed break above the 90.61 level. So that's the first signal to suggest that there's an opportunity to take this market to the upside. And we get the volatility that we're looking for. We get the explosive move that we would like to see. And we're clearly breaking above the structural high. So this means there's an appetite to drive this price to the upside. And then it's down to you as a trader to basically understand what's going on here. All of these traders are looking to drive prices to the downside. And once this structural high is broken, it gives traders fantastic opportunities to take this market to the upside. And again, they get a second opportunity around the 91.40. If you get a confirmed break above that level, there could be a second opportunity to drive these prices higher. So when we look at this price chart now, and we can read what's going on, it could be argued to suggest that if we get continuation in a bit more weakness, that the price is very likely to bounce back to the 40 level. The reason why we know that is because it was a previous level of support and resistance. So when the market is moving to the downside, we're looking for levels of support. And when the market breaks to the upside, we're looking for the key levels of resistance and a break of those levels. So this is obviously how to interpret price action with the view of potentially this market moving down to the 91.40 level. So this is really how traders identify and ultimately understand effectively what's going on in each of these markets, purely from a very technical market structural perspective. So as you can see, we used horizontal lines, but we didn't really use any indicators or any other technical analysis tools apart from that, just to try to identify these structural highs and structural lows, and then show you how a trader is likely to interpret that information. Okay, so moving on then to structural failures. So it's something we've alluded to, and we were looking there. I'll discuss this again just very shortly, where we were looking at the pound dollar. So I do want to just explain structural failures in a little bit more detail. So for this, we can clearly identify a bullish trend. Prices are moving from bottom left, and they're clearly driving to the upside. So what do we see unfold in front of us? We actually see a rejection to the upside, which is a bearish candlestick, and a considerable rejection to the upside as well. So that can now be classed as a structural high. So a structural high has now been created in this market. So the reason why that's quite important is because we, as a result, and this is the relationship between recent price action from structural highs to structural lows and vice versa. And this is how a trader would interpret this particular low, because we get a break above the high to push higher, or attempt to push higher. So what we've done is we've created a structural high followed by a structural low. And when price rolls on, you can see that there's a bit of a failure to break new highs and to break this recent high. So that is supported by a bit of a bearish engulfing candlestick. So this is where other skills and techniques come into play to start to build this picture for you. And as you can see, there's a bit of volatility to the downside, and prices then retrace and close actually below that structural low. And that is technically very, very important when we experience a structural failure. Now, the reason why that's important is because it screams at traders to look for opportunities to sell this market. And what we want to do is go with the markets as opposed to going against them. So we would not be of the opinion to see this very, very bearish setup, see the volatility to the downside, and want to buy this market, especially when we get a break of the structural low and you get a close below that level. It becomes a no-brainer opportunity. Now, it's not to suggest that each of those trades are guaranteed to be winners. It's more the fact that you are stacking the odds in your favor in a very consistent manner. So without doubt, for those sellers that look for these types of setups, it is time for those traders to look for opportunities to sell. And to just give you a live practical example of a really good structural failure, like this breakout here in the dollar index is a major structural failure. And as you can see, you got a nice explosive move to the upside. And it was the, yeah, of course it was the, this is on a minute time frame, and you can see the price bounce back to this level, the 1940 level, but you can see the double bottom that was created and the explosive move to the upside. And this is often how technical traders look at historical price action, and it's very visual. You don't need any particular indicator to be proficient at understanding these structural highs and structural lows. And it can become a no-brainer trade, really, for these prices to bounce back to previous levels of what was resistance, which now becomes support on the way down. and you get a nice indecision candlestick, and a break above that high could constitute an opportunity to drive this price to the upside. And that's exactly what's happened just literally over the last few minutes. So that's just a practical example again of a structural failure, and that's how it all builds together. And it can just provide traders with some no-brainer opportunities to capitalize, and it's all very visual and hopefully relatively easy to be able to identify and therefore trade. Okay, so why market structures present opportunities for traders? Analyzing a chart is like reading a book. So if you can genuinely read what is happening on a price chart, it will become easier to identify what is likely to come next. And therefore, therein lies your opportunity to profit. They can also help a trader with objective stop loss placements. So you can identify those structural highs and structural lows. And if you happen to be buying off a structural low, for example, if you see a double bottom setting up in that market, then you might look to place your stop loss just below that structural low, and that would provide a little bit more reassurance because it's placed at a very, very technical level. So they can also help a trader take profits as well. So you could identify a particular previous structural high and structural low and be able to exit profitably at those levels, depending on the setup. Now, we often see explosive moves can be experienced from these market structures, price points. So whether it's the high or the low, depending on the actual price pattern and the setup, we can often see really explosive moves in either direction. Okay, so just to finish off then, we do need to touch upon the focus of the importance of patience, because patience is actually really quite important. Now, technical traders aim to stack the odds in their favor. That's what they look to do when they trade. So identifying just one technical signal in itself is often never enough to make what are reliable, consistent trading decisions. So this happens to be where patience comes in. So patience is obviously a bit of a virtue, but what it will do is it will increase your quality of your trading success. So it's looking for those quality setups, and ultimately it'll put you in a very good position to, it will allow you time, for example, to assess how your technical trading idea fits in with perhaps the fundamental and the sentiment of these markets. So jumping into the markets is never really to be encouraged. It's always important to look to apply that bit of patience the best way you can. Patience will mean that you won't miss the best opportunities that arise in the markets. And in fact, by its very nature, if you're patient, now if you're hesitant, that's a different problem. But if you are patient, then you're more likely to capitalize on those better opportunities, let's say. And jump on them when they arise. And it's because you've got that foresight. You're doing things in a very considered manner, and patience plays a very, very important role in that. And what it lends itself to is the fact that you won't necessarily be over trading, which is a big problem for traders. They look at the financial markets and they get so excited. They feel the need from a frequency perspective to be trading on a regular basis all the time, and in actual fact that's not necessarily the case. So a useful term to familiarize yourself with: if in doubt, then stay out, and that will allow you to take that time to really trade the markets and look to stack those odds in your favor as best as you possibly can. Okay, so that just about concludes this recording. So we've covered those particular topics currently up on screen. So all that is left for us to do now is to thank you very much for joining us. Do take care, and we look forward to seeing you next time. So from everyone here, bye for now.